Okay, so number 2 on this same set of monetary policy practice problems and looking at the actions that the Fed can take and how they affect the money market and the money supply. We start, some students are confused here by the idea of no international sector. That just means you should ignore the concept of inflow and outflow of capital and ignore net exports, but it's not really going to come into this problem at all in the first place. So first we set up a money market graph and show how an increase in the discount rate will affect nominal interest rates. So let's start with the graph itself, quantity of money versus nominal interest rate, vertical money supply controlled by the Fed, and a downward sloping money demand representing how much consumers want to hold as cash, and that puts us at RE. In this case, if we are going to increase the discount rate is that signal rate to banks telling them to either continue making loans or to slow down the loan making process. When the discount rate goes up, it is a signal that banks should stop any riskier lending practices that the Fed is trying to discourage additional lending, and that is going to lead to a decrease in the money supply as lending slows down. Right? Less lending is going to decrease the money supply. So that's going to help us show a decrease in the money supply on our graph, a shift to MS2 to the left, and then we're going to see a movement over and up to R2. So this is going to lead to an increase in the nominal interest rate. In part 2, how the changes in this interest rate will affect the components of aggregate demand in this economy. So when the interest rate increases, then we see a decrease in what is called interest-sensitive spending. Interest-sensitive spending is spending done by certain groups that is responsive to interest rates. So who are the people taking out loans? And so we mainly think consumer spending on things like cars and other large purchases, houses, though houses are sometimes counted as investment spending by businesses. And in both cases here, higher interest rates will make spending more expensive. And if spending is more expensive, then people will do less spending. So if C and I are decreasing, then we can say that those are components of aggregate demand, and the answer to number 2 is that aggregate demand will be decreasing because it has an inverse relationship with the nominal interest rate. And then the last element here in number 3 is to show this shift of the aggregate demand curve on a AD-AS model. So our AD-AS model is real GDP versus price level, an upward sloping SRAS, short run aggregate supply, and a downward sloping aggregate demand, which will start at YE and PLE. In this case, the question asks only for short run consequences, so the long run is not especially necessary here. We don't need to set up exactly where potential is and where this economy was, and then we just need to transfer over what we just did. A decrease in aggregate demand should shift aggregate demand here to the left, which is going to decrease Y and decrease price level. And so we can conclude that output slash real GDP slash Y nominal income is going to decrease, and price level in this economy is also going to decrease, and both of these are because of the decrease in spending and the decrease in aggregate demand.